Sanjay, on behalf of the entire team ET Now, wish you and your family and your friends a very happy Diwali.
Thank you, Nikunj. It's always a pleasure interacting with you, Ayesha, Niraj. I think it's been ages since we've known each other, and it's been a pleasure every Diwali to be together again. We
Sanjay, please
together
don't make me sound so old.
here
You
again.
say ages as if it's been some 30 years.
I am that way. I think you can look, but so therefore that's the speech you'll hear from me. But we've all been on Diwali together for many years.
Actually, I've interacted with Sanjay for time. When I interact with you on Diwali, privately I ask you one simple question. What is the Diwali idea? Kya lene ka? So let me not change the tradition since we are talking about long association.
It's the bottom-up approach
yes,
that we
since
believe
we're talking
in.
about long association.
Nikunj, I would be a contrarian this Diwali. I would get out of the crowded trade. I would get out of the overextended trade and overextended positions that most of the market has, or I would be probably underweight if not get out into the safe havens, that is the pharma and the IT and the FMCG, which we all tend to crowd into whenever we are in doubt, and stick my neck out into the contrarian trade, and that would be financials, banking, economy linked sectors. Because what I'm seeing is that the kind of work the government is doing and is in the pipeline over the next 2 years is going to really transform most companies which have survived the last 5 to 6 years in these sectors. I see a phenomenal gain for them. I myself have positions in them, so obviously I'm biased. I would stick my neck out, and I always put my money where my mouth is. So my view is that people should be overweight these sectors. And one particular group that I think is well positioned this point of time, I'll stick my neck out again, is the ADAG group in financial services, infra, sorting out the telecom business also. So that's one place to be in for the next 1 year.
Sanjay, but markets ultimately they map earnings, and we've seen that every time when when investors have bought into some of these hope trades have not made a lot of money. So what makes you confident that one should buy into cyclicals or economy related stocks at a time when there is no real evidence of profitability? There is no real acceleration in any kind of an earnings.
I completely disagree there, Nikunj, and I think the point to prove there is it's always the flag bearers of the sector which show the first signs, and we saw State Bank of India last quarter, the numbers we saw last week, and I think all the PSU banks have written down their NPAs and have come down to absolutely touching the bone, as they would say at this point of time, in terms of their asset liability positions. With the interest rate cycle turning up, we're definitely seeing first signs. Investors like us, like me in particular, I must disclose, obviously look at a little bit of more risky trades. So we obviously try to kind of game the trend, game the cycle before it actually gets in. But if you're not the kind in it, you don't want to do it as a lay investor, as a small investor. Obviously, like Ramdev was saying, go to the mutual fund side of it and keep investing in SIPs and keep investing with fund managers who normally tend to just about get their salaries out of beating the benchmark. With no offense to them, but that's what their job is. But if you really want those 2x, 5x, 10x kind of trades in 2 years, then you got to be contrarian at time and understand whether the economy whether the cycle is changing or not. In my view, what you're seeing right now is probably the last kind of a dip you've seen in stock prices, key stock prices, and giving you an opportunity to buy in. And from now on, I don't see any problem in India, barring, of course, any major crisis that may hit the world.
By the way, we cater to all kinds of viewers, and if you indeed want to buy into mutual funds, we'll have a segment for you as well with Narendra in a bit to look at mutual fund ideas. But Sanjay, Niraj here, a very happy Diwali and hopefully a very prosperous next Samvat as well. Since you're playing contrarian, I just want to understand from you if you're playing contrarian on the commodity cycle as well. It could be ferrous metals, it could be soft commodities, it could be agri commodities. But is there a pocket out there in the commodity space where you believe it could be great to play contrarian?
Yes, in fact, metals is, I'm glad you mentioned that, and one or two select soft commodity players. Uh, I have a very long position and a very long in terms of size in one of the metal stocks, which is of course we have a research coverage also from our company on it. In the stainless steel business, the largest player. In addition to that, there are some other metal stocks which are worth looking at. So selectively, metal stocks need to be looked at. Companies which have been able to restructure their debt, manage their debt, etc. On the soft commodity side, a player like Tata Coffee, at these kind of levels, we will be going and paying such premium valuations to a cafe coffee day, a holding company with complex kind of structures. A lot of people will turn around and say that's a plantation company and it has the baggage of legacy plantation assets, etc. But I think it's a phenomenal company to remain invested in and to buy at every dip. So yes, select soft commodity plays, select metal stocks. I think this is the time to buy them, because you don't buy them when they are trading at 8 or 10 multiples. That's the time to sell them. You buy them when they're trading at no multiples at this point of time, probably because they don't have earnings under pressure, and we just see a quarter or two away of earning, and then you see how the entire EV/EBITDA equation starts to change as soon as the cycle turns. So we are positioning ourselves for that. Fair enough. We are in this game of getting our heads chopped off, or laughing our way to the bank. But like I repeatedly say, if you are in this kind of a category of investor where I come from, then do it this way. Otherwise, just stick to mutual funds. Let the fund managers, the smart fund managers, do their job.
The latter, Sanjay. We want our heads on our shoulders. But you were talking about getting out of crowded trades. Now, one crowded trade has been Maruti. Would it continue to make money for investors in the year ahead? Is it time to profit take, because everyone and their uncle owns a Maruti now? That's the share, not the car. But and the other one has been the very interesting one, the likes of a Tata Motors, the speed at which the stock has bounced from sub 300 levels, and just any and every fundamental expert or technical expert on the street out there has a bullish call on it. How do you approach this one, which is sort of dangerously getting close to that overcrowded trade zone?
Very interesting thing I was reading just a short while back, a tweet from a very experienced, economist and a market player. The Tata Group approximately does $14 billion of business in China. That's huge. So picking up Tata Motors from there, I think on any weakness, on any aggressive sell-off, that's the stock to be in. Maruti, I don't think so. Like you said, everyone and his uncle is owning a Maruti car and probably the Maruti stock also. So therefore, I wouldn't like to be in there. Yes, it will make money, 10-15% return maybe, but then you have to game the timing, entry, exit points always, or maybe 20% return even. But that 20% just vanishes. Like you were just talking about Dr. Reddy, just got hacked by 15% in a day. So it's very difficult to game kind of these overowned trades, because it's in everyone's portfolio. Negative news, the exit door is so short, everyone's running out of it. Good news, the entry door is obviously that short, so everyone wanting to get into it. So at those times, one just can't game it, and one can't understand whether one should be getting in or getting out. So that's the reason I don't think a Maruti would make any sense to me. It'll make money, I'm not disagreeing with that, but leave it to the fund manager. Go buy a kind of a sectoral auto fund and play the Maruti that way. But directly, no, I don't think so. Tata Motors, maybe yes. I'm a contrary on that again. Any panic or anything I would want to buy may not be at this level.
So, let's say if a viewer is convinced with your contrarian argument and he says, look, I don't want a fund manager, I want to give the check to Sanjay Dutt and Quantum Securities. And here's my check. After Diwali, Friday morning, it lands on your desk. How will you invest?
Firstly, I can't take a check and invest his money. I can only guide him with caveats and warnings of where he's putting his money as a broker. That's what I'm supposed to do. So therefore, my caveat, I begin with that. Like I said, if you have money to make it 2x, 3x, 5x, then you should be putting in where I'm saying, easy trades, I'm not the person to come to. So therefore, to answer your question, to cut it all short, and as they say, cut to chase, I would have exposure to metals selectively. I would have aggressive exposures to financials and banking. Depending on the turnaround because I'm banking on a big turnaround in the economy. I'm banking on a big turnaround in manufacturing in India over the next year or 2 years. So therefore, selectively, like I said, I mentioned a particular industrial group, which is a nice set of companies which have undergone, in fact, why a lot of people would be short those companies at this point. I won't be surprised. So I would want to buy them. I think there's phenomenal amount of opportunity in the market at this point of time, other than pharma, IT, and automobile, etc. Let the fund managers handle those. Take out some money. Come to a stupid broker like me, and take the bet this Diwali, because next 2 years are very good years for equity. Next 2 years are very good years for contrarian players. Bet on the economy. Bet on India for the next 2 to 3 years.
Sanjay, you've been one of the first ones to really sort of stick your neck out on real estate as well. Does that continue to be a theme that you like for the year ahead?
Not really, because that sector's got problems still, because most of the real estate players are not willing to encash their inventory. They're still holding the price line. Price lines are artificial in particular product segments they're selling, particularly in the upper segment. So I'm a little wary there, barring 1 or 2 companies that I would like to play. But as a sector call, no, I don't think so, because the aggressive investor demand, the people who used to come and park money in real estate, buy 10 flats, 20 flats, 50 flats when projects used to be launched, that investor is dead and gone. So it's only the actual user, slow growth demand that's there for this sector. So therefore it's got pain there. It's got pain there for another 6-12 months. It'll have its bursts of activity, and you'll see a rally here, rally there, and a DLF or India Post Real Estate or something. But sectoral call, I don't think so. No, not as yet. A little too early.
Well, Sanjay, really appreciate your time. Glad you could join us. I know this is family time and you have to get back to your Diwali puja. So thank you for joining us, and wish you a wonderful year ahead.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.